Hello, everyone. This is the Keeping It Real in Real Estate show, and I'm your host, Kathy Blakey. I'm a realtor with Century 21, a marketer, entrepreneur, and nature enthusiast. In this podcast series, I'm going to take you on a journey as we explore topics in real estate, including the market, mortgages, common inspection issues, sustainable future, and more. Are you a homeowner? Future homeowner? Do you like saving money? Enjoy healthy living? Then this podcast series may be for you. Stay tuned as we go deep into these topics. And don't forget, subscribe, like, and share. One of the very first steps in buying a home is to get pre-qualified or pre-approved for a mortgage. Some of the factors that lenders look at are your income, such as how much do you make, what's your employment history, the stability of it. Basically, what's your ability to pay the loan back? Another factor is assets. Do you have enough money saved for your down payment, enough to pay the closing costs, and then some left over in what we call reserves? Finally, one of the other factors in getting pre-qualified or pre-approved is having good credit quality. And that is going to help the lender to determine your likelihood that you'll repay the loan that they're going to be giving you to buy your home. So credit quality, it's based on your credit file, and that often includes your payment history, both good and bad. It includes open lines of credit and how you utilize the existing credit that you have. All that information is compiled, and more of course, compiled into a score. And that is what our topic is going to be covering today. What is a credit score? How does it impact your lending ability? How to improve your score? And more. Stay tuned. So today we're joined by Bernie Doherty with Pike Creek Mortgage. And I'd like to just have Bernie go ahead and introduce himself.
Well, thank you very much for having me. I've been in the business now 21 years and with Pike Creek Mortgage for over 11. I've held titles such as Senior Loan Officer, Specialty Lending Director, and Business Development Manager. I was an instructor for the Delaware Association of Realtors for 5 years, in which I designed and taught mortgage financing and the credit courses so that realtors could obtain and maintain their licenses. Of all those, I've enjoyed actually being the loan officer the most. Every day is different, and you get to help people accomplish a life goal, which is extremely rewarding. Since my move to Pike Creek Mortgage in 2008, I've been supported with the best staff and technology that money can buy. We have one owner, it was a producing loan officer, so it was important because he understood exactly what we deal with. And now we are the largest independently owned mortgage company in the tri-state area. We're extremely proud of our reputation, not only with consumers, but also real estate professionals. So thank you.
Thanks, Bernie. I'm really pleased to have you on our show today, and we've got a lot of great topics coming up. So I really think there's some myths when it comes to credit scores, and let me give you an example. When I'm getting ready to show homes to clients, I always ask for a pre-approval, and there's good reason for that. Sometimes clients don't know what price range they're qualified for, so getting a pre-approval letter really helps to narrow down that pre-approval range. And not only that, there's a payment comfort. You may be interested in a $300,000 house, but then you find out that the payment that goes with that's not really comfortable. And so pre-approval letters is a prerequisite for showing homes. But occasionally I have customers who tell me that they don't want to have their credit pulled. And they just quote for me the reason being is that it's going to drop their score, ruin their score, essentially ruin their credit and stop their chances of getting a mortgage. And so one of the reasons, Bernie, I wanted to have you on our show is to help me dispel that myth, or at least shed some light on that and let our listeners know to what extent does that really happen.
So I guess one of the hot topics is regarding credit is that pulling credit will actually hurt your credit score. Now, this is not true when pulling a score for the first time from a lending institution. There's a 30-day buffer built in for mortgage and car financing so that your score will not drop should you shop for the best deal. So in other words, if you pull your credit from a mortgage company on Monday and then try another one on Tuesday and try another one on Wednesday, the 3 scores will be the same as long as, the information in the score has not changed, or in the report itself has not changed. So I understand that some consumer reporting bureaus will show that there's a hit to the credit when pulling credit, but that's not true when it comes to borrowing money. And obviously borrowing money is the most important part. Now, when pulling credit months apart, now for a mortgage report, the credit report is good for 120 days. But when pulling them months apart, this is where the score can take a hit. Now, with a strong score, with a lengthy history, little or no delinquent payments, and active, responsible accounts, pulling the credit will have a very light hit to the score. If you have stressed credit, stress report, collection accounts, high debt ratios or high ratios to balances or to limits on your credit cards, then that's going to have a much heavier effect. Either way, it's not designed to drop your score significantly.
Okay, thanks, Bernie, for that. Appreciate the insight there. So what I hear you saying is that if you've got good credit already and you're consumer shopping for your interest rate and it's within a limited window of time, you as a consumer should not expect to be impacted by that. But on the other hand, if you have borderline credit and you have some other issues going on with your credit score, at that point you're already considered stressed. So we could potentially see some limited impacts to your credit score.
Outside that 30-day window. So if you only pulled your credit one time, then no, you're not going to see an effect to the score. But outside that 30-day window, you could see a drop in your score due to pulling the credit.
So Bernie, why do people see different scores on their report? I don't know that I understand why we see different scores.
So credit's a complicated thing. I mean, there's an algorithm that analyzes an incredible amount of data to produce a credit score, and each industry computes their own score. This means you can have a different credit score with a credit card company, a car loan, a mortgage, and your consumer credit report. And this can be confusing for people when they see one credit score given to them by their credit card and another credit score when we pull credit for their mortgage. One thing to remember is that the scale itself is different. If you pull for a mortgage, there's 3 reporting agencies we'll pull from, and the highest score you can get is 844, and that's through Experian. However, the maximum score you can get with Equifax on a mortgage pool credit report is 818. So even in the same report, the scores can vary. Now, the basics are the same. So you start with small trade lines that you can build organically into larger trade lines, meaning that you start with small credit card limits, 250, 300, 500, and allow the credit card companies to increase these lines so that way your credit builds. Now, the trick is to use them wisely. Keep your balances under 30% of the limits. It's not important that your credit card has a limit of $300 or $3,000. It's important as how they're used. So knowing the algorithm, meaning knowing to keep it under 30%, will be the best way to increase your credit score and also help rebuild credit from any times there were problems in the past.
Okay, thanks, Bernie. Appreciate that insight. All right, so suppose we have a buyer who has a low credit score, or maybe had no credit history at all. What would you recommend?
First things, separately, on someone who has a lower credit score, you want to devise a plan and stick to it. Repairing or building credit is not generally a quick fix. So this could take several months to build up that score and put you in the best possible position to borrow money. Number 2 is identify the items that could be causing the most problems to the score. If you have no credit, obviously you want the smaller items so that way you can build them up. So like I was saying before, you want to get a small credit card. In cases where you have no credit whatsoever, sometimes you need to get a secured credit card, which means you give a bank $250, they give you a line of credit. Now going back to, you want to be specific on how you use it. Less than 30% of the limit, and then try to pay that off on a monthly basis. And what's important about that is activity. You want to make sure that you're not buying something on Friday and then turn around and paying it off on Monday. You want to wait for the bill to show up and then pay the bill off. That way it shows activity on your credit score. Now, sometimes we need these balances to be paid down on credit cards because they're above that 30% or even 50% of the limit. And you want to be able to show the algorithm, the ratio is bigger now between the limit and the balance. So, and lastly, don't wait. The clock on a credit report only starts when the information changes. So if you did not get a credit card today, then the clock didn't start. If you didn't start paying off a collection account today, then the clock didn't start. If you wait, then you're just pushing back the clock. On lending reports, accounts generally only reported once a month, so you may need several months of healing in order to get your credit score higher. So if you're looking to purchase in the fall, I would recommend pulling your credit in the spring. So you want at least 6 to 12 months ahead of time, so especially on your big ticket items such as cars and mortgages.
All right. Thanks, Barney, for that. So get a plan and stick to it and don't wait. Sounds like a plan. Let's get these credit scores as high as they can be. So now we know a little bit more about how to improve your score. Bernie, why don't you tell us how the score is used and why it's important to know your score?
So your credit score generally is an indication of your risk level for a bank to lend money. The simple fact is, the higher the credit score, the cheaper your life you have. Even insurance providers will pull credit and have an adjustment to pricing if your credit scores are lower. So as you can imagine, someone with a 760 credit score will have a cheaper interest rate than someone with a 620 credit score. The idea is to review your score several months in advance prior to financing. And that way you can make your score higher. By making some small adjustments or simply educating yourself on your credit report, it could make a big difference in the type of program you choose and obviously the cost.
So everyone wants to save money. No surprise there. What would you say would be the best recommendation for anyone looking to get the best financing terms?
Simply knowing the hand you're playing with will help you significantly when shopping for a loan. When calling a bank and asking for their interest rates, knowing what your financial scenario is will dial in exactly what type of loan you qualify for and help understand the costs. Simply calling up someone and saying, hey, what's your interest rate, could cause a problem when they pull your credit and find out you don't qualify for that particular interest rate. The other area would be knowing the questions to ask and asking for a breakdown of costs. Many lenders advertise a particular rate. However, the consumer that is shopping doesn't necessarily ask for the cost for that interest rate. If most banks are giving out 4.5% and a bank gives out 4%, you can bet that there's a very high probability that there's a cost associated with that interest rate. It's challenging to say when the best time to shop is. Interest rates, especially for mortgage financing, come out around that 10/30 mark to allow the stock market and the markets to move. And then we have an adjustment according to that. Since we have a global economy, something could go wrong or right somewhere, which could make the markets move and adjust the pricing behind interest rates. The simple fact is to control what you can control. If you bring a strong financial profile to the table, you have the best opportunity at the cheapest products out there. Remember, there are items associated with loans such as the size of the down payment and the term of your financing. And these items can also have effect on the interest rate as well.
Okay, thanks for that great information. Okay, suppose some of our listeners know that their score is low. They have the steps that you've outlined to get them started to improve the score, but they kind of just want to see where they are at and see if they're on the right path. Do you have any recommendations for them?
Absolutely. There's a number of consumer credit reporting agencies that are out there. MyFICO, obviously Credit Karma, etc. So what I ask them to do a lot of times is to send me a copy of their consumer credit report so we can analyze the data in there. That way they send it to me and I can go through and give them a step-by-step procedure and also how to go about it and which ones to attack first. A lot of times, especially when there's been life changes, divorce, bankruptcies, medical, things of that nature, people just look at something so big and they go, where do I go from here? And it's helpful to have someone say, okay, send me the report. Let's go through, attack this, and then do this. So step 1, step 2, step 3. And by doing that, it's a more efficient use of your time and your money.
Thanks, Bernie, for coming on the show. I really appreciate that, and I'm sure our listeners have enjoyed the insight that you provided, and we will be sure to have you back at another time to cover more great topics in the kind of depth that you were able to cover this topic. So I'm going to leave with asking you for a little more information. If you could kindly provide your licensing information and contact information.
No problem at all. Thank you very much for having me. My name is Bernie Doherty. I work for Pike Creek Mortgage. I am licensed in Delaware, Pennsylvania, and Maryland. My contact information is 302-598-0136. My email is bdoherty, and that's B as in boy, DOHERTY @pikecreekloans.com. And my NMLS number is 146770. Thanks again for having me.
Thanks for tuning in to this episode of Keeping It Real in Real Estate with Kathy Blakey as your host. Visit www.keepingitrealinrealestateinfo.com. And if you haven't already done so, don't forget to subscribe like, comment, and share. Also, if you or someone you know would like to become a guest speaker on this podcast series, please contact me on my website. You can also find me by searching the key terms Kathy Blakey Realtor. And you should be able to find me on YouTube, Facebook, LinkedIn, or Instagram. I look forward to hearing from you. As a disclaimer, this show is not intended to be used as a replacement for professional advice. For specific issues relating to your real estate transaction, please consult with your qualified realtor, mortgage broker, home inspector, or real estate attorney. Thank you.